Hey, welcome back, everyone. Tom here from Park Avenue Trading, your chief dealer, keeping you sane in insane markets. Today, we're going to cover something quite interesting. I've been seeing a lot of little ads on YouTube about Richard Dennis and the turtle trading systems back that were very, very popular in the late 70s, throughout the 80s, and even the 90s. So the objective is like imagine being handed a secret trading formula so powerful that it could turn complete beginners into millionaires in just a few years. Would you follow the rules to the system? Because they're not easy rules to follow. Okay, matter of fact, Richard Dennis's turtle trading system was wrong 70% of the time. Now, I knew actually one turtle trader, one that got fired. I won't mention his name. I met him in the 90s, and there was a big rage, in the 80s about this group that like had this super secret formula uh, and how they traded. But the turtle trading system is a very, very simple breakout system. It's like very, very similar to 𝐬𝐮𝐬𝐫𝐞 channels, breakouts. That was really what it was modeled after. And what Richard Dennis did was he what he did with the legendary turtle traders, it was basically an experiment. And some people think that the movie Trading Places actually came from the experiment that he had with his partner, Bill Eckhart, because he said that he could build traders or train traders like they grow turtles in Singapore. He was a very, very big advocate of going to Singapore and on vacation, and he noticed that they used to have turtle farms. And, they would grow turtles for food, right? So he said he's going to grow turtles. He's going to grow traders like they grow turtles over in Singapore. So that's why they were called the turtle traders. Now, Billy Carp, didn't believe that. He thought that to be a trader, there was something innate, and Richard Dennis didn't think that. He said that it could be taught to the right people. And what the problem that most people had was they couldn't follow the rules, especially the guy I knew. And I won't, like I said, I don't even know if he's still alive. Matter of fact, let me Google to see if he is still alive. Yeah, he is. And actually, the article I'm reading about him is saying that he was a legendary turtle. He got fired from the group, so that's really interesting. But anyway, as it stands, what we're gonna be going over is the turtle trading rules themselves. They're very, very simple to follow. And ultimately, like I said, they fail 70% of the time. So the Prince of the Pit, Richard Dennis, believed that trading success could be taught. It wasn't just innate talent. So he trained the group of regular people, teachers, gamblers, accountants, and called them the Turtles, right? Some of them are still out there today with their own hedge funds. Of course, they modified their rules. There was one famous turtle. His name was Curtis Faith. He wrote the first book, I think, on turtle trading. It's still on Amazon today, I believe. Now, what's really interesting is that Curtis Faith said that he was retiring. He had enough money to retire. He was only at the time, I think, 25, 26 years old, or let's say 27, 30 years old maximum. He said he had enough money to retire. He recently got arrested for robbing a 7-Eleven. You could Google that. Now, the reason I know about it is because there's a famous like feud between Michael Covell, who wrote Trend Following. A very, very good book. If you're interested in trend following, I suggest that you get Michael Covell's book on trend following. And he basically wanted the turtle name. He wanted the site somehow. So they got into a little bit of a tit for tat. And Covell pointed out that you were just recently arrested for robbing a 7-Eleven. You're so damn broke. Now, I don't want to get in the middle of that, but that's something in between Covell and Curtis Faith. But it is true. He was arrested for armed robbery. So strange things happen to people. It's just amazing. But anyway, let's get into this system. Okay, so the first thing that we want to talk about is we want to say that the turtle trading system worked best in inflationary markets with commodities. Okay, so the reason is that when there's inflationary trends, commodities tend to move in an upward direction consistently, and they can stay in an upward direction longer. Now, we could look at Bitcoin and we could try to apply the theory to Bitcoin as well. Bitcoin also reacts to, inflationary pressures, it also reacts to basically M2, right? Global liquidity. So the more global liquidity, there's more liquidity out there where the rates are actually flooding, the rates are actually getting lower. Bitcoin seems to thrive in that environment. Um, and the opposite is true when rates start getting tight. Bitcoin seems to fall because people they look at the asset itself as, a risk on type of asset. If they can get a better yield someplace else without the volatility, they'll likely get into it. Now, Bitcoin itself, I'm not gonna, I do Bitcoin for the other group. You could see the link in the description at Merlin, the trader. I do their Bitcoin analysis and it's great, it's fun, but I'm just applying this for Bitcoin. So if you're looking for trend following, maybe you want to look into, something like this. That's up to you. But the thing is that I got my little notes here and I gotta try to remember the key points I want to hit. What we're doing with Richard Dennis's turtle system is it's nothing more than a 20-day buy breakout. So, in other words, if a marketplace goes over the high, and they used it like religiously, like 3 ticks above the previous high, they were buying the market. Okay. Um, if it went 3 ticks below the 20-day low, they were selling the market. Now, they used two types of stops. They used a volatility stop where they were using average true range. And they would figure out what the average true range of the last 20 days was. And then for every specific thing they were trading, they had a certain specific money management formula for. So they would never trade more than 2% of their count on any one trade. But the initial trade was set off of, I believe, off of a certain money management due to volatility, how much money they could actually enter, how much money they could use. And then their stop loss would be set at a certain rate. Now, once the trade started to move in their favor, up or down, they would use a 10-day volatility stop. So if they were long, let's say they got long anything, and the market started moving up strongly in their favor, and they would start trailing with a 10-day stop. So they would go in the chart and they would look for the lowest point 10 days, and if it dropped below that, they would just square the trade. Okay, so let's look at Bitcoin and let's go back and let's try to apply this to Bitcoin. All right. Um, okay, so well, let's look right in this section right here, just the March 2025. Okay. If we're looking at this marketplace right here, okay, well, obviously that's a 20-day low, right? If we come back, let's look right here. Say we're trading right here, right? We want to go back and we want to look for 20-day low. Look, that's 24 bars back. So we know that that's a 20-day low, right? So I'm going to mark that. Now, the turtles would sell this a couple of bucks below, they're short. Stop loss at a certain amount of volatility, right? For sure, they're going to get stopped out. Okay, so remember I said, if you just apply this system as far as 20 bar low, 20 bar highs are concerned, without really taking any economics or any macro levels, you're going to get hurt a lot. Now, the turtles were technical traders, so they would, regardless, take these trades, okay? Because they went with technical analysis. If the 20 bar low broke, they're selling. If the 20 bar high broke, they were buying. So they would sell this low, since it was a 20 bar low. It went very, very, didn't really go that much lower in their favor. And of course, this is taking this from this point. if I went back in time, I could probably find a 20 bar low that brought me down to this point. But let's say we didn't do that. Let's say we started off right here at this point. Well, now they also had another rule too. They had another rule that if the previous 20 bar low broke and it worked, they wouldn't take this trade. So that's another rule. All right, but that's getting really deep into the woods. However, if they had a 20 bar low before that failed, they would take this trade. So there's a qualifier right there. That just came to my mind because I'm remembering. I don't really write anything down. I just remember basically the rules as I was taught them, and that just came to me. So the rule would be if the last 20 bar low broke and worked, they wouldn't take this trade that we're looking at right now. If the last 20 bar low failed in the past, they would take this trade. So now we can go back and we could, okay, let's have fun with numbers. Okay. Right here, let's get the measurement like right from here. Let's say we're trading right here and we want to go back in time. Yeah, that's a 20 bar low right there. Okay. So here we go. Right. Let's pull this down. Market breaks this. And it works. I mean, there's a reversal here, but so they wouldn't really be taking this trade, okay? Because this one broke the 20 bar low. It did go down. They wouldn't have taken this trade. But anyway, let's just say, for instance, in other words, they wouldn't have taken this trade. Let's just say, for instance, we negate that just so we could see how the whole system works. This trade failed. The 20 bar low broke. It failed. Now, from this point, okay, they would go from here. As this is happening, they would go back in time 20 bars right here. And they would say, okay, what's the highest point, right? Well, that's the breakout on the upside. So if they would have taken this trade, if anything, they would have been reversing and going long right here. They would have went long right here. This is the highest bar in the last 20 bars from this point going back. This was the buy point, right? Market break up, boom, they're long. Now, look at this. That's a nice trade, no doubt. So what they're looking at right now as this marketplace is moving, they would be going back in time and at this point they would say, "Okay, go back 10 bars. What's the low?" The 10 bar low, hang on, let me make sure if they were right here. Let's get the measurement right so I can see what's going on here. 10. 10 bar low is actually right down here, right? A little bit less. It's actually the entry, the daily entry, the low of the day. Okay, that would be their stop. Now, as the market keeps progressing, let's say from this point, they're constantly monitoring where the 10 bar low is, right? So we go back, let's go down here. There's the 10 bar low right there. Okay, so they would mark this. Let's mark that spot. Let's come down here. Boom. They would have been out. So they would bought 89,000s and they'd be selling 100,000 599s. Now, they would have squared that trade. Now, don't forget, now they're also in the hunt. So that is a 10 bar low. The next, if you go back in time, you could look, it's also probably a 20 bar low. But also, so if that means the marketplace broke through that, they would sell it. Now, where's the 20 bar high? The new 20 bar high is right there, 112. Okay. Oop, they would have sold this. They would have sold that dip down. Okay. And they would have been stopped out. Okay. Now let's see what happens here. They would have bought this top because it's 20 bar high. They would have bought it. Okay. And marketplace ripped up, went up to 121. And at this point, they would have been looking for a 10 bar low to escape out at. Uh, right there. That's the 10 bar low that they were looking to escape out of. Let me pull this up. So that would be the stop, right? Right there. Yeah. Market's still coming up in their favor. And at this point, again, they'd be looking for a 10 bar low to get out at. Right here, the original actually entry. Boom. They would have been out. Okay, right there. So they would have broke even on that trade. So that's how it works. Okay. 20 bar high or 20 bar low. Now, they had an emergency system. They had, if you missed a 20 bar high breakout or 20 bar low breakout, you would go to a 55 bar time period. Okay. And the same rules would apply. So 55 bar high breaks, you're going long. 55 bar low breaks, you're going short. And you use a volatility stop. Now let's move over to, let's check out gold. You can see how gold actually works very, very well with this because, as I said, it works really great with commodities. Okay, so if we go back in time, and everybody was talking about gold going up, because of inflation. So really, you could see it. Really, you didn't really need 20 bar breakout, right? I mean, you could have used Fibonacci levels. You could have used lots of different things. But if we're looking at the marketplace that's trading right around here, and let's say we're here, okay? What we want to do is we want to go back. Okay, so here's the 20 bar high right there, right? So let's mark it. 20 bar high right there. They would go long right here. Bang. Now they have a volatility stop on it. Okay. Um, I wouldn't think that this would be enough. If they got long at 3004, no, they would not be stopped out. But here we go. Marketplace retraces and then it starts moving progressively higher. As they're in this trade, as it's moving higher, what are they doing? They're looking for a 10 bar low to escape out of. And I'm going to just say, I think that right from this point, that's your 10 bar low, if anything. And then let's see, yeah, they would have got stopped out right there. So they would have got long where, like, hang on here, like right there, 24, 2004, 60, and they would have got out at 2006. Now, guess what they're doing? Okay. Now they're looking for a 20 bar low to sell or the new 20 bar high to buy. Okay. So let's just check this out. Here we are from this point. Let's go. All right. So hang on. I think it's going to be that point. Hang on. If we go from here, we go back 20 right here. That's this point itself. It's basically a double top. This point has now become the new 20 bar high to buy right there. Okay. And look what happens. Bang. Look at that takeoff. So look at that movement. All right. So that was a great trade. So now you can see how the turtles, they never risked more than 1% of, or 2% of their capital. They use volatility based sizing, bigger positions in calm markets, smaller positions in very volatile markets. Now, they exited trades very, very quickly. They rode the winners using trailing stops, the ones I just showed you. Okay. Um, they created an asymmetric payoff. So very small losses against massive winners when the winners came. They were 70% losers. 70%. Very, very hard to trade this system. You know, so they had discipline over emotion. They had no gut trades at all. Every decision followed a system, entries, exits, and the risk rules were always applied. They proved that the system beats emotion every time. That is true. Um, However, like I said, the one guy that I met in the 90s, he couldn't follow this system. And now I just looked him up and he's back to following the turtle rules. I don't know. And they're acting like he was like the end all be all. He got fired. Richard Dennis fired him. So, I don't know. And I know for a fact he found him because he was sour grapes for a long time. So, you know, if you're looking at this, there was also a book, there was also a trading system that was put out. It was called Turtle Soup. It was put out by Linda Rashi. And I can't remember the name of the book. I see the cover of the book, but I can't remember the name of the book. It was put out in like 1990. But it basically was the opposite of this. So, and I used to use it when I was at the bank once in a while. Even using daily, not daily bars, I would use 4 hour bars and say, look, we went through a 20 bar high, came back down through that 20 bar high. I would sell it, put a stop at the, I'll show it to you. It's real simple. Let me go over to good old, what is this, dollar yen. I'll show you something. I haven't used it in a long time. Let's go to a 4 hour chart. It's a very simple system. All right, so look at this. Here we go. If I was just looking at this market right here, I could see that if I go back in time, here's 20 bars, right? Let me come down here. 20 bars right there. Okay, so 20 bars, I would say actually this was the top. Okay, you say, well, wait, Tom, this was one, two, three, four. This is actually the 20 bar high. I would actually, as a technical trader, go like that's really the top. Okay, because that's the point, that we had a nice, real big movement down off of. But if you're following the rules, that's your top right there, 20 bar top right there. And what do? Well, marketplace comes back up through the 20 bar top, comes back down through it, you sell it, stop loss, like 15 ticks above this high. That's it. And then look at the marketplace moves right back down. Well, where can it move to? Well, it can move down to here. And look what it did. It does come down to there. So, if you sold 148.80s, stop loss 149, 43. Look at it. Look at the R value. Same thing. You can do the same thing with the 20 bar low. Now, it does. That's actually what's called turtle soup. Okay, that's trading against what the turtles would be doing, and it's also done on a lower time frame. Okay, so you have limited risk, and you could have some decent reward. That's a nice little system. It really is. You can go back and test it. You could check it out. Now, there's sometimes you get caught. You get chopped up a couple of trades, 3, 4 trades in a row that don't work. But when the ones that do work, they really do work. They work pretty well. All right, so I'll leave you with that. Leave some comments for me if you found it interesting. The turtle system proved one thing: trading success isn't about brilliance. It's about following a plan with absolute discipline. And I don't care what you're trading, you got to have absolute discipline. So the question is, are you willing to trade like the turtles? Are you willing to trade like a turtle? Can you follow those rules? Okay. Can you stick to a system and let time do the work for you? Because there's a lot of times you're going to lose a lot in a row with the turtle system. And it's very, 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 very punishing. But if you found this lesson valuable, please drop a comment. Um, I got to ask you a question. Would you have joined Richard Dennis's experiment? Would you have been able to do it, you think? You think you would have been able to stick to those tough, stringent rules that he had? Again, leave the comments for me. Remember, if you like what you see, share my videos far and wide. Don't forget, okay, as a short-term trader, always, always, always enjoy the party, but dance near the door. Cheers.